Buying a business can be overwhelming. So many steps, so much jargon, and a ton of potential pitfalls. But today, I'm going to make it easy and even a bit of fun. I'm going to walk you through the A to Z of buying a business, literally A to Z. There are 26 essential steps that cover everything you need to know, from finding the right opportunity to closing the deal. Whether you're a first-time buyer or you're looking to grow your portfolio, this A to Z guide will simplify the process and boost your confidence. And later, I'll share a game-changing tip that most buyers completely overlook, one that could save you thousands and speed up your first acquisition. Are you ready? Let's dive in. A is for assessment. Before you even look at a business, you need to know exactly what you want. What industry are you interested in? What's your budget? Do you want to be hands-on, or do you want the business to run without you? Focus on businesses that are profitable but underperforming. These are gold mines waiting for the right buyer to unlock their potential. B is for business valuation. You need to know what the business is worth to you before you talk money. Look at earnings multiples. How many times the profit is the business worth? Asset valuation. What's the value of the equipment, stock, and property? And cash flow analysis. Is there enough cash flow to pay for itself? If the seller's valuation is based on projected revenue, be cautious. You should be buying based on actual performance, not optimistic forecasts. C is for cash flow analysis. The biggest reason businesses fail is running out of cash. Make sure the business has consistent cash flow and working capital to cover day-to-day expenses. Look at the last 3 years of cash flow statements to identify seasonal trends and cash flow gaps. D is for due diligence. This is where you verify everything the seller has told you. Financial due diligence. Check all the financial records for at least 3 years. Operational due diligence. Understand the day-to-day running of the business. And legal due diligence. Check for lawsuits, compliance issues, and contracts. If the seller is reluctant to provide documents, walk away. They are hiding something. E is for earnouts and payment structures. An earnout is where you pay a portion of the purchase price based upon the business's future performance. Why it's powerful? Well, it reduces your risk. If the business doesn't perform, you pay less. And it motivates the seller to ensure a smooth transition and continued growth. Include clear performance targets in the contract so there's no ambiguity about how much is owed. F is for financing the deal. Now, you don't need to be rich to buy a business, you just need to be strategic. Seller financing is where you negotiate to pay a portion over time. Asset-based lending is where you use the business's assets as collateral, and investor financing is where you partner with investors who fund the deal in exchange for equity. Always start with seller financing. If the seller is retiring, they're more likely to accept deferred payments. G is for growth strategy. You're not just buying a business, you're buying a platform to grow and scale. And here are 3 proven strategies. Cross-selling, sell complementary products or services. Geographical expansion, open new locations or expand delivery areas. And 3, acquisition integration. Buy competitors or suppliers to control more of the value chain. Look for businesses that are profitable but underperforming. With the right strategy, you can double or triple revenue very quickly indeed. H is for handover and transition. The deal doesn't end at closing. You need a smooth handover to ensure continued success. Keep the seller involved. Have the seller consult for a few months to help with the transition, and introduce yourself to key clients and suppliers to maintain relationships, and then communicate with staff to prevent uncertainty and boost morale. Include a handover clause in the contract, ensuring the seller is available for training and transition support. I is for integration strategy. Buying the business is just the start. How you integrate it determines its success. Operational integration is where you merge systems like CRM, accounting, and HR. Cultural integration is where you align the team with your company's vision and goals. And brand integration is where you decide whether to keep the existing brand or rebrand under your own. Integrate quickly, but don't rush cultural changes. Focus on financial and operational integration first. J is for joint ventures and strategic partnerships. You don't always have to own the whole business to benefit from it. Joint ventures are where you collaborate with another business to enter a new market or share resources. Strategic partnerships are where you align with complementary businesses for cross-promotion and referral networks. Equity partnerships are where you bring in investors or partners for financial backing and expertise. Make sure roles and responsibilities are clearly defined in the contract to avoid disputes. K is for key employee retention. One of the biggest risks in buying a business is losing key employees who are critical to operations. Retention bonuses are where you offer bonuses for staying throughout the transition. Incentive plans are where you provide profit sharing or stock options to align their success with yours. And clear communication. Be transparent about the future to reduce uncertainty and build trust. Identify the top performers before the acquisition and lock in their loyalty with clear incentives. L is for legal contracts and agreements. Contracts protect you and minimize risk. So make sure that you have a purchase agreement, clearly outlining the terms and conditions of the sale, a non-compete agreement, preventing the seller from setting up a competing business, and warranties and indemnities that ensures the seller is liable for any misrepresentation of facts. Always consult with a deal-savvy lawyer who specializes in acquisitions. This is not the place to cut corners. M is for marketing strategy. A solid marketing plan can double or triple your revenue post-acquisition. So you need customer retention campaigns. Keep existing customers loyal and engaged. You need cross-promotion. Leverage your existing business assets for cross-selling opportunities. And you need digital marketing. Invest in social media, email marketing, and SEO to expand reach. Focus on the 80-20 rule. 80% of revenue often comes from 20% of the customers. Identify your top buyers and nurture those relationships. N is for negotiation skills. Buying a business isn't just about what you pay, it's about how you pay it. For example, price anchoring. Let the seller state their price first. Use deferred payments, pay a portion of the price over time using the business's own profits, and earnouts. Link part of the purchase price to the business's future performance. Always be willing to walk away. The more willing you are to walk, the better the deal you'll get. O is for operational efficiency. The quickest way to boost profitability is by cutting unnecessary costs and streamlining operations. For example, automate routine tasks. Use tech solutions for inventory, CRM, and payroll. Reduce your overhead costs. Negotiate better supplier terms or outsource non-core activities. And standardize processes. Create systems that allow scalable growth. Implement a continuous improvement program. Small, regular improvements lead to big, long-term gains. P is for post-acquisition plan. What you do after the deal closes is just as important as how you negotiate it. Our 90-day integration plan is where you outline everything that needs to happen in the first 3 months. You can have quick wins, identify areas to increase revenue or reduce costs immediately, and a communication strategy. Keep employees, customers, and suppliers informed and engaged. Measure your key performance indicators, that's KPIs, weekly for the first 90 days. This helps you catch issues early on and adjust your strategy on the fly. Q is for quick decision making. Deals can fall apart fast if you hesitate. You need to set clear criteria. Know your go or no conditions before entering negotiations. You need to trust your due diligence. If the facts check out, move quickly. And you need to avoid overthinking. Perfect doesn't exist. Done is better than perfect. Create a decision matrix. It speeds up decision making by focusing on objective criteria. R is for risk management. Every business comes with risks, but the key is to identify and mitigate them before you close the deal. There are financial risks. Check for debt, cash flow volatility, or customer dependency. There are operational risks. Evaluate supply chain reliability and employee turnover. And there are legal risks. Look for pending litigation or compliance issues. Use a risk matrix to prioritize risks by impact and likelihood. Then develop contingency plans for the highest priority risks. S is for seller motivation. Understanding why the seller is selling is the key to better negotiations. It could be retirement. They want a clean exit, which is ideal for seller financing. It could be burnout. They might accept a lower price for a fast sale. And it could be financial pressure. They may be open to creative payment structures to solve immediate cash needs. Ask questions like, why are you selling now? Or what's your ideal timeline? The answers can reveal leverage points for negotiation. T is for tax implications. If you don't plan for taxes, they can eat into your profits and take you by surprise. For example, stamp duty and capital gains tax. Understand your liabilities in advance. There's asset versus share purchases. Well, each has different tax consequences, so you need to choose wisely. And VAT implications. Make sure you're compliant, especially if buying in the UK. Work with a tax advisor who specializes in business acquisitions. This is not an area to do yourself. U is for unique selling proposition, the USP. A strong USP makes the business easier to grow and sell in the future. You can identify customer pain points, solve a unique problem better than your competitors. Then there's brand differentiation. Position the business as unique in the marketplace. And then there is competitive advantage. Secure exclusive supplier contracts or patented products. If a business doesn't have a strong USP, look for ways to create one post-acquisition. This could be through branding, product bundling, or enhanced customer service. V is for valuation adjustments. Don't accept the seller's valuation at face value, adjust it to reflect reality. There's the working capital adjustment. Ensure the business has enough cash for day-to-day operations. There's the debt adjustment. Subtract any outstanding liabilities from the purchase price. And then there are profit adjustments. Normalize profit figures by excluding one-off expenses or owner perks. Always use a discounted cash flow model, DCF, to calculate the present value of future cash flows. This gives you a more accurate valuation. W is for working capital. This is the lifeblood of any business. It keeps day-to-day operations running smoothly. So you need to have a minimum working capital clause. Include this in the purchase agreement to ensure enough cash flow post-acquisition. Then there's cash flow forecasting. Make sure the business won't run out of money during the transition period. And then there's asset-based lending. You can use the business's assets to secure short-term working capital. Always ask for detailed accounts receivable and payable reports to understand the cash flow timing. This helps you avoid cash crunches. And X is for exit strategy. Sorry, that was the best that we could do. Before you buy, you need to know how you'll sell or exit in the future. You could sell to a competitor, maximize value by selling to someone looking to expand their market share. You could do a management buyout, an MBO. You could sell to the existing management team for a smoother transition. And then there's a private equity sale where you sell to investors looking for a high growth acquisition. Identify potential buyers before you buy the business. It shapes how you structure and grow the business from day one. Y is for yield and return on investment. The whole point of buying a business is to get a return on your investment. So do an ROI calculation. Divide annual profit by the total investment to calculate the yield. Then there's the payback period. How long will it take you to recoup your investment? And then there's the cash on cash return, where you measure the cash income against the cash invested. Aim for an ROI of at least 20% to justify the risk of acquisition. If the numbers don't add up, walk away. And Z is for zeroing in on the deal. Once you've done all the research and due diligence, it's time to focus and complete. So stay decisive. Don't get stuck in analysis paralysis. Negotiate the final terms, finalize those payment structures, warranties, and handover terms, and then seal the deal. Sign the contract and celebrate. You are now the proud owner of a new business. And always keep a plan B, another deal or opportunity in the pipeline. This keeps you mentally strong and negotiating from a position of power.